Hey everybody, Marty Missouri, good morning. The 27th of August, 2019, Tuesday. This is your pre-market open, trying to get in the habit of giving you something just to start your day and give you some perspective on the market. There's a lot I really want to share with you that I want to illustrate for you in terms of the longer term trends and what I'm seeing and why we remain pretty cautious right in here. But just this morning, we'll just talk just briefly about what we're seeing right now, real time, and kind of how the market's reacting to it all. First of all, just a narrative on the U.S.-China situation. Clearly, no phone calls were placed a couple nights ago, as the president had claimed. We were looking at, and I illustrated for you yesterday, we were really looking at a setup that was going to make the bears happy come Monday morning. Those tweets came in early Monday morning, and that really kind of saved the market, at least at that moment. We've got some follow through here. So you might say, well, if China isn't really coming back to the negotiating table, why then, if this is really all that the market's trading on these days, or most of it, why then are we trading higher this morning? I think there is something very constructive in that news, and that is that the president, I think, has gotten the message from the economic data and clearly from the markets that this is that tariffs are a very destructive way economically to get what you think needs to be done on the global trade front. And I do think things need to be done with China, folks, don't get me wrong. The trade deficit that the president keeps talking about, however, is not the issue, and that's the one that he continues to really pound on. At G7, in his press conference afterwards, he didn't even mention technology transfer and intellectual property theft. He talked about $500 billion a year that China is taking out of the U.S. And longtime clients know I've spent a lot of time over the years writing about this, and I really hammered it hard during the Obama administration when he was applying tariffs to tires and solar panels and these other things that were being imported to the U.S. A bilateral trade deficit is utterly meaningless economically, meaning one country's trade deficit with another is like us having a trade deficit with Nevada or Oregon. The money could go from us to Oregon, and then Oregon to Nevada, and then Nevada back to us or some other state. It's a circular situation. And you might say, well, what about currencies? It makes no difference. When the U.S. buys stuff from China, we're implanting U.S. dollars into China. Now, the people who sell us stuff will convert that to the renminbi or the yuan, but somebody there still holds dollars that have to come back to the U.S. They can buy something from another country that's denominated in dollars. A lot of commodities, oil throughout the world is denominated in dollars. It just circulates throughout on its way back to the U.S. A lot of it comes back and buys our treasuries, and we're issuing a lot of treasury debt right now. But those dollars that you and I send to China, they don't just get shredded. They come back to the U.S. either in a roundabout way or directly. We have a monster capital account surplus with the rest of the world. So that offsets the trade deficit that we have, meaning we buy more goods and services from the rest of the world, and the rest of the world buys more stocks, bonds, treasuries, real estate, and so forth from us. So it's worked for us quite nicely up to this point. But politicians, be they on the left or on the right, frankly, it used to be more so on the left until lately, would really try to exploit this misunderstanding, in my view, to gain political favor, because it feels like there's kind of an us and them mentality. But they generally stop short of really doing economic harm. President Trump seems to see an advantage there. I think he maybe sees a lever to get some good things done, like maybe get China to stop doing the bad things that they're doing. But doing that with tariffs really is just taxing U.S. importers. Remember, it's the U.S. company who imports the good who writes the tariff check. And then they've got to make up for that. Either they're going to need to cut somewhere, and ultimately it becomes labor perhaps, but they're definitely going to be trying as best they can to pass those costs on elsewhere. And of course, that would be the consumer. And when you have an economy where the consumer is strong enough, well, then you can get away with that. But you can't do it for too long. So again, and I said this a couple of days ago, it appears to me that the president is becoming sensitive to that and is getting a better understanding of what ultimately goes on there if you take this too far. But it seems like his style is to not let anyone really know that that's how he feels. And to continue to forward this narrative that the trade deficit is a bad thing and he needs to fix that. Therefore, tariffs will do it. But here again, the market rallying in here and doing pretty well in the near term, I think speaks to the fact that clearly his saying that they called the other night and are desperate to make a deal says that he really wants to make a deal. So ultimately, when it comes to tariffs, we need to come to a resolution where both sides save some face and so on. But China needs to be taken to task on some other things that they're doing. We just need to find another avenue for doing it that's not so self-destructive. So, okay, so we're moving within this trading zone. Make no mistake, folks, we are going to break out of this in one direction or the other. Right in here, I was certain it was going to be in this direction through commentary from Washington. Right now, we're keeping within this range. If you look at the near-term volume trend, you could argue that the breakout ultimately is going to be lower. You can see volume or conviction beginning to wane in here as the market was topping. And then, boy, the bears came in force, huge volume. Each time the market has rallied back to resistance, volume has died down. And then when the market has dropped, volume has risen. We see coming out of this, look at the huge drop in volume. And then the market falls, and then we get a big pickup in volume. Pretty good volume bar there, although it's still down. And then this, of course, is just this morning, so too soon to tell. This suggests that there's a whole bunch of caution in this market. So this, and if you look at other trend indicators, you might argue that we're going to ultimately drop down below this. But the powers that be seem desperate to keep that from happening. We do get to a point that if this gets out of control, and I think it can, and some of my longer term indicators are saying that that's likely, then we have bigger, longer term issues to talk about. So just little hints of what concerns me right now and what I'm seeing. And more of that to come in the near future. It's like we're moving up this morning. It's anybody's game at this point on a near-term basis. It wouldn't be that surprising, quite frankly, in the near term to get up here and test these all-time highs. If we delayed the tariffs or cancel the tariffs that are due to go in September and December, and I think that's a distinct possibility, I think you're going to see a lot of money rush in, and you're going to see this market rally. In the longer term scheme of things, we have got to get rid of the existing tariffs that have been put on over the last year and a half, because those are doing real structural damage throughout the world. The longer we do that, I can tell you with certainty, the longer that we're going to see the deterioration underneath things, the more the Fed is forced to come in and prop asset prices up, the worse the ultimate reckoning is going to be with those underlying trends that are breaking down. So right now, cause to be cautious. The jury is still out in terms of which way we ultimately resolve. I think there's still time to change course in the areas that are really causing the underlying trend to break down. If we do that soon enough, I think we can reaccelerate, get back into expansion mode for the next couple of years maybe. Get interest rates higher so the Fed will be in a better position to do battle with the next recession. The next one I think is going to be a doozy, because I think it's going to hit the corporate debt market in a big way, and it has real negative implications, and I think it's going to smell like 2008 when it ultimately gets here. Whether it's in the next 6 months to a year or in the next 2 to 3 years, when it comes, we're going to be dealing with something I think that's going to feel pretty ugly to the downside. So while the risk is there that something could morph into that in the near term, you're going to hear a very cautious tone from me, and we are going to continue to act accordingly within client portfolios. Thank you, folks, as always, for watching and listening. I'm going to be back very soon. Take care.